Thanks for tuning in to Talking Point. I'm your host, Dhiraj Shah. Our guest today is Dhiraj Agarwal, MD of Ambit Investment Managers. Dhiraj, great having you as always. Thanks for taking the time out.
Morning, Neeraj. Thank you for having me over.
No, the pleasure is ours. So, well, we are closer, Dhiraj, to the big Fed event than we were. It's an interesting conundrum in that the markets may have been disappointed if growth was very strong, because then the markets would have thought that, oh, the Fed will not move on rates. Now the growth has started to shake a little bit, and therefore the markets believe the Fed will cut rates, but because growth is wobbly, should one be worried? So the market is finding its own reasons. I'm trying to understand, how do you think about risk assets if we are looking at a period of the next 3, 4, 5, 6 months of some significant rate easing by global central bankers?
So, two things, in this whole discussion, we often made valuations as a third key important variable and the third key pillar of this whole situation. We're just looking at macro and the news flow and the possible impact. Now, the valuations and the strong rally on which the market stands at this point of time, whether it is US. Dheeraj, did I lose you?
No, I can hear you loud and clear, Dhiraj.
Yeah,
I can hear you loud and clear. Yeah.
So the current valuations on which US and India particularly, the two markets stand, and a very strong rally in the last 1 year, markets will find its own reason to worry a little bit and force a little bit of correction, right? So that is one point. Second is, it is indeed a tightrope walk. All of us like fairy tales, all of us want Goldilocks, not too hot, not too cold, but reality is often not that Goldilocks, right? So markets have been wanting a rate cut and a sharp rate cut, but they don't want economic slowdown accompanying it. You have to be careful what you wish for. So it looks like markets may get their wish this time, which is a very sharp rate cut cycle, but it might come with some negative economic data, which might not be very good for the markets overall.
Okay, so what wins? I mean, you reckon because valuations have been a concern now the last 12, 18 maybe months, or everybody who's been sitting on cash are licking their wounds as well. What do you think triumphs? Do you think valuation concerns and slower growth triumphs? Or do you think fund flows and a rate cut triumphs in terms of sentiment and therefore markets staying steady or even moving higher?
So interestingly, Neeraj, sharp rate cuts are usually not good for equities in the near term. Gradual rate cuts have a mixed track record of whether they are good for equities or bad for equities. Actually, if you analyze the data over 40, 50 years, it's almost 50-50. The probability is no better than a coin toss. A sharper rate cuts which create expectations of many more sharp rate cuts in the near future. Logically, I mean, if you think about it, we step back. Logically, would make bonds a lot more attractive than equities. Because let's say, theoretically speaking, market starts to believe that USA might cut rates by 200 or 250 basis points within a span of 1 year. Your 30-year treasury is it's almost like a sitting duck in terms of where you should park your money, right? I mean, why bother with equities risk? So this is one of the reasons why money tends to flow out of equities and chases bonds in the near term. Second is obviously, as you mentioned, that sharp rate cuts also sort of communicates to the market that is the economy weaker than what we are reading in the data prints. Does Fed know something which we don't know? Is Fed panicking a little bit? Those concerns also surface. But the first one itself is powerful enough. I mean, it's fairly logical.
Fair call. Just one small question on that before we move to India, and which is that the belief almost is that, and you're right, I mean, I was reading, I believe a Citi note which said that their data analysis also, like yours, seems to suggest the first 1 or 3 months, it's negative and then it turns positive. But usually also a rate cut cycle or a rate easing cycle gets accompanied by changes in fund flows towards emerging markets as well. You reckon that could happen because India's weight in MSCI EM is now significantly higher. We might even eclipse China at some point of time. So what happens to that part of the equation?
I don't know is the right answer on this one. We have been waiting for incremental FPI flows in the country as our weight in India, weight in MSCI has been going up. Indian economy has been doing better relative to certainly the entire EM world. And there's all the logic that FI should be increasing their weight to in the country. But contrary to that, FI weight has actually come down in the last 7, 8 years from 21, 22% to current 18.5%. So that's a little bit of that's a little bit of a mystery, I think, to some extent. So it's very difficult to predict that actually if the FI flows will actually turn because of the rate cut cycle. Let's see.
Okay, fair call. The template the last couple of days seems, or last maybe a week, Dhiraj, seems to have been that don't bet on defense, but bet on defensives. You're starting to see the emergence of staples, maybe some of the underperforming private sector banks sporadically showing a bit of an uptick as well. And the defense railways theme has taken a bit of a backseat. You reckon the template continues for the latter half of the year?
Yeah, so I think you hit the nail on the head when you said underperforming banks. So in general, in the last 2 or 3 months, we have seen re-emergence of the underperforming sectors, right? So it started with IT, which was the first sector to show a very, very strong bounce. It started perhaps in May and June itself. And then we saw follow through in FMCG, completely ignored sector for a while, and now we are beginning to see in private banks a little bit. I mean, that's still sort of struggling. It's still just a 2 day, 3 day phenomenon. Let's see if it stretches. But yes, that's what has been happening. Money has been moving out a little bit from the strong performing sectors into weaker performing sectors. I call it winds of change. So there is certainly a cycle rotation underway in favor of sectors which have underperformed in the last 2 or 3 years, and with some amount of logical reason and catalyst. So there is a slightly higher government support to consumption in this budget. Many state governments are providing various kinds of subsidies or incentives to boost consumption and the bottom of the pyramid economy. We have seen a little bit of an uptick in consumer data and consumption data even in the last GDP print, also in the commentaries of most FMCG companies. So that's doing well on that end. On the IT services, very interesting observation I made recently was that the sector's ex-Mag 7 earnings growth in the last quarter actually beat the analyst estimates by almost 70-80%. And that's usually good news for IT services. I mean, that results in order flows beginning to pick up for Indian IT services with 1 or 2 quarters lag. So there are some green shoots in IT services as well. Private banks is purely a relative valuation game at this point of time. I mean, there's nothing wrong. Earnings have been coming in. There are no issues in NPLs. Valuations have gotten derated. Many participants in the market now find attractive value out there. So to answer your question, yes, the winds of change, I think, should last for some more time. Few quarters for sure, few years, I don't know at this point of time, maybe.
Okay, fair call. Let me try. Okay, I'll probe about the ones favored in a moment, but I have a bit of a cross question on a couple of themes, Dhiraj, which have been performing. And viewers, look at this chart. I mean, this is a chart of maybe given about 8 days or 9 days ago. But here's a chart which shows, let's say, real estate, a sector which has done really well. And fundamentally, pre-sales numbers have looked okay. Inventory is seen at the lowest level since 2008. In India, and I presume this must be tier 1 cities and not necessarily India wide, but be that as it may, this looks very solid from an inventory data perspective. But Dhiraj, it's a sector which has now started to plateau out a little bit. So I'm trying to focus on themes which have done really well. A lot of people might already have investments there, and therefore I would love to know, how do you think about some of these? So let's start with real estate, because it's a wide economic impact sector too. What do you do with the pure play real estate players now that there has been a rally for the last 24 to 36 months?
So Neeraj, the answer is purely in time horizon, right? So as you rightly pointed out, real estate sector is doing well. One of the biggest variables which gives me confidence that this cycle for real estate will last longer than let's say either 94 to 97 cycle, or sorry, 92 to 94 cycle, or 2003 to 7 cycle, because the price rises have been more moderate and gradual as compared to, let's say, 2003 to 7 cycle. So in 3 to 7, home prices, let's say in cities like Bombay, went up 10x in a span of 4 years, which obviously killed demand at the end of 4 or 5 years. I mean, it went into speculative demand and finally killed demand. This cycle, the price increases are more like 10, 12, 14% per annum, which is more digestible. So it can last. However, in the near term, from a stock price performance point of view, the plateauing effect might be visible for some more time because market has just started focusing back on valuations a lot more than what the market was focusing on, let's say, even 4 months or 5 months ago, and trying to seek pockets of safety. So it's not reflected in the index because one sector sort of struggles or corrects, but another sector comes back into momentum. So like IT and FMCG is holding up the index at this point of time. But there is a slight amount of risk off effect in the market. Investors are focusing more on numbers than on narratives. The focus on valuations have come back. The focus on relative safety has come back. The animal spirits has gone out a little bit. So it could consolidate for a while more.
Got it. Some recent developments, and we'll talk about GST in a moment, but one big development that happened, Dhiraj, is the passage of the Biosecure Act. It just got done this morning as per Bloomberg. Now, there's a lot of talk about impact that something like this could have for pharmaceutical companies, non-China pharmaceutical companies across the world, because the Biosecure Act seems to target some specific Chinese companies. Now, I would love to know if you've given this some thought. Sorry, this come out in the open in the morning, so I'm throwing this out of the dark at you. But any thoughts on what some moves like these could do? Are these really big moves? And is Indian pharma well poised to benefit from this or other trends?
I think it is. So pharma has been in a very strong uptrend now for a few years. And this is one sector where despite the strong uptrend, I mean, barring a couple of pockets here and there, valuations are not completely out of whack, right? So valuations are still supportive. So the whole pharma uptrend started with generics becoming a little bit more in tight supply in the US. And the price erosion for generics, which was 20%, 25% per annum, came down to mid-single digits. Globally, many of the generic players, because of almost a decade of very deep price erosion, actually shut down. So there was meaningful consolidation in the sector. Indian generic players became much better positioned from a competitive advantage point of view. And now the Biosecure Act, I mean, the whole genesis of the act is that US is feeling pinch of high drug prices and a little bit of shortage in some of the pockets as well. So this gives the further fillip or boost to CDMO contract manufacturing Indian pharma players. And by itself, does this change the industry fundamentals around? I don't think so. But industry which was already doing well, there was already a very, very strong reason to say that US generic market is now stabilized, price erosions are not there, and Indian companies will benefit. This is an added, I would say, lever for the Indian companies to do well. So this is one sector which I think is in a secular trend for many more years to come as well.
By the way, viewers, watch out for the stocks today. I mean, Syngene is up about 1%, Lotus Labs, I think, up about 4%, Newland Labs could also be in the green today. Divi's is up about 3%. So some of these stocks are seeing that impact in the session today. Now, stay on Dhiraj because I want to get in my colleague, Mahima, to talk about the other aspect, because some of the cancer importing companies or cancer drug importing companies are also doing well because of the GST move that has happened. It's the current news, and Mahima joins in to put that into perspective. Mahima, good morning.
Good morning, Neeraj. So basically, the rate on cancer drugs has been considered to be reduced from 12% to 5%. Now, this could potentially benefit and you're also seeing stock movement in these companies today. This includes Abbott India, Zydus Life Sciences, Alchem Laboratories, Cipla, Biocon, and AstraZeneca Pharma. Now, it's not just the pharma companies; there are also snacking companies which have benefited from the recent GST changes, where rate for excluded and expanded savory snacks has been reduced from 18% to that 12% mark. So all snacking company stocks are up and above in trade today. This includes Pratap Snacks, Bikaji Foods, Gopal Snacks. There is also GST on car seats that has been increased from 18% to 28%. Now, one player that has been impacted because of this is Bharat Seats. There's also an introduction of reverse charge mechanism on metal scrap. Now, this basically means that if an unregistered dealer is selling metal scrap to a registered dealer, the registered dealer will be liable for paying the GST taxes. Now, this is impacting stocks like metal scrap recyclers who buy these metal scrap. This includes Gravita India and Pondy Oxides and Chemicals, and also steel companies which are not really moving in trade today on the back of this news, but there is Tata Steel and JSW Steel which could possibly have some impact. So these are some of the stocks which have seen impact on the back of the GST changes that took place yesterday.
Thanks, Mahima. Dhiraj, any thoughts here? I mean, again, too early, just happened overnight, and if not just on the current moves, but broadly on the fact that there is some recognition around what could be happening at the rural end, so some snacks, savories, etc., also seeing some GST cuts there. Do you think the alignment of decision making is happening with trying to boost sentiment and fortunes at the rural end currently?
I think Mahima did a fantastic analysis of all the impacts on the GST cut. So not much for me to add. But yeah, I think in general, there is a slight shift in the government policies towards focus on consumption as well. So overall, in general, there is a slight more awareness of the fact that the bottom of the pyramid has not been doing as well as the middle and the upper end of the pyramid. We saw that little bit of shift in the budget also, where more allocation was done to all the rural schemes and consumption boost. Government consumption expenditure itself as compared to the interim budget was hiked by almost 200 250 basis points. So yeah, I mean, overall there is a shift, but nothing, no more micro addition. I think Maima did a fantastic job of capturing everything, much beyond perhaps even what I knew.
What I was trying to understand is, so we've gotten the GST impact, but I'm just trying to think whether the GST changes plus all the other things make you believe that rural consumption-led players could now be a forefront, because they also, I mean, they are never cheap, but relative to what they've done in the past and the last 18 months not going anywhere, do they present that relative value currently? Let's say staples, for example.
I think so, yes. And see, I mean, as you rightly said, they're never cheap. But if there is ample liquidity in the market, the liquidity will always try to seek uh, areas where the marginal rate of change is moving up and move out a little bit where marginal rate of change is moving down. So in many of the capital expenditure areas, the marginal rate of change is either stagnating or moving down slightly. The absolute rate of change is still healthy. And in the consumption area, the marginal rate of change is moving up. So yes, we will see that shift continue for some time more.
Got it. Dhiraj, what about non-lending financials? Sorry, I'm moving subjects now because we spoke about banks, but I want to bring in the non-lending financials into the picture simply because after a really long time, life insurance is making its presence felt on the daily screen. And we already seen that despite regulatory moves, the buying interest in, let's say, for example, the wealth or the asset managers is not dwindling. Those stocks are making new highs every second, third week as well. So what about non-lending financials? Do you like that bucket? And if so, what do you like and why?
Yeah, I like that bucket. So, I mean, most of them are long-term structural plays on India, right? On financialization of savings, on increased allocation to equities, increased requirement and desire for protection, which is insurance. So whether they're capital market players, insurance, uh, those are clearly in a, I mean, the business cycle itself is in a 10, 20-year uptrend. So even now, on an annual basis, just 4.5% of household savings go into mutual funds. This number can easily rise to 12, 14, 15% before it starts to struggle. So it's a long journey. I mean, we all know Indians are underinsured on the protection side. Historically, we considered insurance as yet another savings instrument. It's only in the last few years that we have begun to realize that better to consider fixed deposits or mutual funds as savings instruments and insurance as protection. So these are long-term trends and pretty much here to stay.
Got it. Speaking of long-term trends, there is another chart, of course, which we will bring. But Dhiraj, I mean, just wanted your view on the new age tech companies. Now, you're constructive on IT services, which I heard you say that, or maybe if not constructive, you at least see green shoots there. I would love to know, what do you think about the tech-enabled consumer companies, or maybe they are tech companies with a consumption angle to them, but they've done really well. And the newer features are getting added, which are making their presence felt. Blinkit in Zomato's case, or some other cases. Do you like this whole bucket? Even Paytm is starting to move up. So I'm not asking you to speak about specific stocks. I'm just trying to understand, how do you think about the tech-enabled businesses?
So, I mean, tech-enabled businesses, by definition, if you get the business model right, and the TAM is large enough, your incremental revenues come at extremely high margins, right? Because the infrastructure is the same. And once the infrastructure is built, the incremental revenues keep on boosting your margins. So if you're in that space where the TAM is large and you can keep on capturing large market share, I mean, you mentioned Zomato and Blinkit, for example. So without commenting on the stock value evaluation at this point of time, I mean, this is a market which will continue to grow for the next 20 years. It's a duopoly at this point of time. And as more people order, as AOVs keep going up, the margins will keep expanding. Whereas there could be many other, let's say, consumer companies, for the want of a better word, which use digital primarily for distribution. There, the whole matrix on TAM may not be very clear. So this whole digitally enabled services or digitally enabled businesses, I mean, each company is so different, and each the target market is so different that it's very difficult to brush them all with the same brush. And also the competitive intensity, right? I mean, food delivery and groceries now are duopoly, or at best a three-player market. So the competitive intensity, which was very high, let's say 6, 7 years ago, 5, 7 years ago, has come down. So that also will determine how profitable you can become. If the competitive intensity or barriers to entry is very high, then it's tougher.
Got it. Where are you most worried, Dhiraj? Aside of the fact that you are worried on valuations, because you brought up as the primary point when I asked you the first question, where is it that you are most worried about?
Apart from valuations, I think the one little shock that we saw in August, and that almost immediately vanished at that point of time, but we should not write it off completely, is the dual impact on the entire global financial system of US cutting rates and Japan increasing rates. So for last 5, 6, 7 years, it was very easy for the Japanese money to flow offshore as yen was in a structural depreciation mode. So as per one data I read on Bloomberg, I think the Japanese offshore investments over 19 to 24 expanded by almost 3 trillion yen or thereabouts, which is about 1.4, 1.5 trillion US dollars. That's a huge sum of money. So as the US rates come down and Japanese rates go up, could there be a large-scale unwinding? I don't know, but the risk is high. How does it impact the global financial market stability, whether it is fixed income or equities? Again, very difficult to predict at this point of time. It's one of those things which you can't analyze and put a number to it. But I think it's a large risk, which since I mean, I saw a trailer of that on August 5, which was the day of the worst crash since the Black Monday of 1987 for global markets. Nikkei was down 12% on one single day, but immediately it stabilized. Doesn't mean it can't revisit at some point of time. So I worry a little bit about that.
Point well noted. Okay. Dhiraj, we covered a wide gamut of topics. Didn't quite flow one after the other, but it was just good to get your brains on a lot of these. So thank you so much for sharing the thoughts, and thanks for your time today.
Thank you very much for the interaction. I enjoyed it too. Thank you.
Yep, thank you. Well, that's the Ambit view on a bunch of things. Keep in mind that the markets are flat completely, with Nifty IT being the only one which is really shining, now about 0.75% higher, with the likes of Coforge, which has got a big thumbs up from brokerages leading the charge, I presume, but a clutch of other names also doing rather well for themselves. With that, it's a wrap on this leg of Talking Point. Thanks so much for tuning in.